The goal is to grow non-automotive metrics. Innoviz possesses
Sigma, they completely liquidated. 100%
automotive OEM design cycles, management
timelines, relying on the harsh reality of delayed automotive timelines.
for a decade. The technology isn't just good.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
Following the fourth quarter earnings release, Innoviz Technologies saw its price action violently compressed down to the 0.85 level, a move accompanied by massive, highly irregular off-exchange volume on February 25th, where we saw 208,431 total finished shares traded, with an off-exchange short volume of 143,440 shares, creating a staggering 51.32% short volume ratio. Those aren't normal retail trading numbers. That sheer scale of off-exchange, dark pool activity forces us to ask a really critical question about the underlying reality of this company. Does this sub-$1 price action and intense microstructure volatility represent a highly lucrative, quiet accumulation phase by institutions, basically buying into an undervalued pioneering physical AI company, or does it reflect severe execution risk and a desperate narrative pivot by a struggling hardware supplier facing the very unforgiving realities of mass manufacturing? I argue that the fundamental business here is drastically improving. We're looking at 127% year-over-year revenue growth, massive positive gross margin swings, and quantitative models, the so-called smart money, utilizing these dark pools to quietly load up on shares at an absolute trough valuation.
Well, you were pointing to the top-line percentage growth, which, it always looks impressive in a vacuum, but the absolute numbers tell a much more fragile story. The $3.6 million fourth quarter revenue miss exposes deep near-term execution risks. And this recent pivot to the physical AI narrative, it appears to be exactly that, a narrative, a buzzy distraction from the harsh reality of a hardware business that is heavily reliant on securing new bridge financing while simultaneously staring down the very real structural risk of a NASDAQ delisting. We really need to look beyond algorithmic trading volume and focus on the fundamental capital structure and the immense manufacturing hurdles ahead of them.
I understand the skepticism around the phrase physical AI because it does sound like an easy buzzword. But let's look at the financial realities driving that turnaround in 2025, because the underlying metrics were nothing short of transformative. Total annual revenue hit $55.1 million. But far more importantly, the gross margin swung an incredible 2,800 basis points. They went from a negative 5% in 2024 to a positive 23% in 2025. This isn't just a rounding error. Going from losing money on every unit sold to a 23% positive margin is the hallmark of a maturing business model, finally optimizing its cost of revenues.
Percentages are great for a slide deck, but percentages don't pay the light bill at the Fabrinet manufacturing plant. Yes, the margins improved on low-volume production, but look at the actual cash requirements needed to scale. Management's forward guidance relies heavily on securing $20 million to $30 million in entirely new non-recurring engineering payment plans, the NREs.
Which are standard in the automotive supply chain.
Standard, yes, but highly precarious when you rely on them for survival. For our listeners less familiar with the terminology, NREs are essentially the upfront R&D fees that partners pay to customize a product. Relying on them to this degree means Innoviz is still operating heavily as an R&D lab for hire, rather than a mature company selling a finished, off-the-shelf product. It indicates they desperately need a cash bridge from these partners just to fund the scale-up of their manufacturing capacity by 3 to 4 times their 2025 levels. Operations expenses are still hovering at $80.6 million. The capital burn is absolute. Relying on hoped-for future R&D contracts to keep the lights on is an inherently fragile position.
I wouldn't call it fragile. The reliance on engineering payments is a natural, really an unavoidable stepping stone toward mass commercialization for complex sensor suites. And elite institutional capital clearly recognizes this maturation process. You don't have to take my word for it. Just look at the recent 13F filings. Citadel Advisors increased their holdings by an astonishing 658.37%. They are holding over 1 million shares and 648,100 call options. That leveraged directional positioning is a high-conviction bet on a substantial upward re-rating.
Citadel operates on multiple fronts, though, often hedging.
But it's not just Citadel. Cube Research increased its position by 312%. And Renaissance Technology is widely considered one of the most sophisticated, mathematically rigorous quantitative funds on the planet, opened a brand new position of nearly 2 million shares. These are not emotional retail investors. These are algorithmic models that target specific statistical risk-reward profiles, and they clearly see the current 0.85 valuation as a severe market mispricing.
You bring up the funds buying in, but we have to look at the institutional churn as a whole, because that bullish sentiment is directly contradicted by the funds aggressively running for the exits. Morgan Stanley and Millennium Management, they both slashed their positions by approximately 50% in early 2026. Wexford Capital and Two Sigma, they completely liquidated. 100% decrease, a full exit from the stock.
Generalist funds leaving while specialized quant enter.
It's a rotation that is highly concerning, though. It shows the traditional growth funds, the ones who typically hold for long-term commercialization, are losing patience with the continually extended timelines for Level 4 vehicle autonomy. Two Sigma is incredibly sophisticated, and they decided the opportunity cost of holding this asset was simply too high, and this brings us back to the strategic pivot you mentioned earlier, the shift toward physical AI.
Right. And I argue this is a necessary strategic masterstroke. They are deliberately diversifying away from the incredibly lumpy, unpredictable automotive OEM design cycles. Management has explicitly stated the goal is to grow non-automotive revenue up to 10% in 2026. And we already have hard evidence of high-margin traction here.
Let's examine that evidence, though.
Just look at the March 3rd partnership with DataSpeed, Inc. Innoviz is integrating its Innoviz Smart LiDAR into DataSpeed's drive-by-wire platforms across North America. This targets off-highway sectors, agriculture, mining, heavy industry environments where sensor durability is absolutely paramount. Combine that with the February 11th announcement of security infrastructure deployments in Israel, combining their LiDAR with PTZ cameras and advanced analytics, and you have immediate, tangible commercial viability entirely outside the traditional, slow-moving automotive constraints.
The DataSpeed partnership and the security deployments are interesting edge case applications. I won't deny that. But they are a drop in the bucket compared to the capital required to sustain an $80 million annual operating expense. The upcoming March 23rd Physical AI webinar, which management says will focus on bringing world models to life, is a classic, transparent tech maneuver. It is an attempt to secure software-like AI valuation multiples for what is at its core a heavy hardware manufacturing business.
It's not just spin if the hardware actually acts as the physical infrastructure for the AI.
But long-term survival does not depend on a few off-highway prototypes in a mining quarry. It wholly depends on traditional automotive scaling, specifically the Daimler Truck Level 4 Class 8 initiative. We are talking about heavy, long-haul trucking. That sector requires much higher sensor density per vehicle and yields significantly better average selling prices. If Innoviz fails to deliver on the Freightliner Cascadia platform, no amount of physical AI narrative rebranding will save the balance sheet. They are a LiDAR supplier. They will live or die by the automotive supply chain.
I disagree with the premise that they are merely a LiDAR supplier. They are an AI infrastructure provider, specifically because of the hardware evolution you are downplaying. The release of the Innoviz 3 module in late 2025 represents a massive technical de-risking event for those very OEMs like Daimler that you just mentioned. We're looking at a sensor unit that is 60% smaller than the previous generation. It allows for true behind-the-windshield integration without ruining the vehicle's aerodynamics or aesthetics. More importantly, it is 35% cheaper to produce, which is the absolute holy grail for mass market adoption of Level 2+ and Level 3 autonomous systems.
Miniaturization is impressive, certainly.
But it's the computing architecture that defines it as AI. The smarter variant of the Innoviz 3 integrates the NVIDIA Jetson Orin Nano directly onto the device for edge computing. For the listeners, edge computing means the sensor processes the massive wave of data itself in real time, rather than sending raw data to the car's central computer and choking the network. It pre-aligns and synchronizes precise 3D LiDAR geometry with standard RGB camera data,
which is incredibly complex to manufacture.
but vastly superior in performance. LiDAR inherently beats traditional cameras and radar because it directly converts photons, actual light bouncing off objects, into precise 3D mathematical geometry. It doesn't have to probabilistically guess or infer depth the way a 2D camera does. And its blockage resilience, the ability of the laser pulses to function through water droplets, mud, and heavy dust, solves the primary real-world edge case that has plagued autonomous vehicle deployment for a decade. The technology isn't just good, it is structurally required for autonomy.
I will concede that the foundational technology, the MEMS design, and the electro-optics engineering are world-class. No serious analyst disputes their engineering talent. But there is a massive valley of death between building a hyper-advanced, miniaturized prototype with an NVIDIA supercomputer inside it and mass manufacturing that exact unit flawlessly, millions of times, at a Fabrinet facility. You mentioned the 35% cost reduction and the severe size constraints. Achieving those specific metrics on a high-speed production line while maintaining rigid automotive-grade reliability is notoriously unforgiving.
Which is exactly why they partnered with Fabrinet, a top-tier contract manufacturer.
Yes, but the core issue remains the timeline to commercial viability. Innoviz has $111 million in remaining NRE contracts. That's $66 million existing, plus the hope for $20 to $30 million in new engineering plans we discussed earlier. Converting those custom engineering contracts into tangible, recurring high-volume product sales is an immense hurdle. Operating expenses were indeed reduced by 20% recently, which is commendable, but they still sit at $80.6 million against a total cash position of just $72.1 million. The margin for error in scaling this hardware is practically zero. If the 2027 and 2028 starts of production face any macroeconomic slowdowns or technical delays on the assembly line, the bridge financing collapses before they reach profitability.
A coiled spring implies immense stored energy waiting for a release. And that is exactly what the market microstructure of Innoviz is showing us right now. The persistent off-exchange trading is telegraphing imminent upward pressure. Let's look at the fails to deliver shares that were sold short but never actually delivered to the buyer. We saw 465,642 FTDs on January 12th alone. Furthermore, throughout early March, during the final 30 minutes of trading, the heavily algorithmic power hour, we consistently observed clusters of block trades. We're talking 50,000 shares or more per tick, absorbing retail sell orders directly at the 0.85 floor.
Block trades at the bid aren't inherently bullish, though.
They indicate that massive institutional limit orders are resting quietly in the dark pools, happily accumulating the floating supply without spiking the public price. With official short interest sitting between 11% and 12%, and over 9 days to cover based on average volume, any significant positive catalyst will trigger a violent technical short squeeze. And those catalysts exist right now on a macroeconomic level. Look at the United States Department of Defense. They just outlined a $66 billion AI budget for 2026. Look at the 143.8% increase in the Air Force's budget for force application AI. Innoviz's high-throughput 3D sensing, especially its ability to differentiate small objects at high speeds, is perfectly positioned as a counter-drawing capability. The macro tailwinds for physical, defense-oriented AI are massive and directly aligned with INVZ's pivot.
I think interpreting massive dark pool volume as a guaranteed coiled spring bullish indicator is fundamentally dangerous. Off-exchange volume, particularly the 50 to 68% short volume ratios we saw in late February, is rarely a directional bet. It is often just major market makers like Citadel Securities or Virtue Financial internalizing retail flow and balancing their algorithmic books. It is liquidity provision and basic risk management, not a high-conviction long bet by an insider.
But combined with the Renaissance accumulation,
Even so, the microstructure data is entirely secondary to the operational reality. And while you point to U.S. defense budgets as a macro tailwind, you are entirely ignoring the explicit micro-geopolitical risk that directly threatens their ability to execute any of these contracts. Innoviz is an Israeli company headquartered in Rosh HaAyin. Their annual reports continually and explicitly highlight the risk of military reservist call-ups. In the current geopolitical climate, those call-ups are not theoretical. They actively threaten R&D timelines, management capacity, and basic operational continuity. You cannot model the U.S. Department of Defense budget as a pure financial tailwind without acknowledging the very real physical and human disruption happening in their own headquarters.
The geopolitical situation is undeniably complex. But the company's heritage as an elite technological unit born out of the Israeli intelligence apparatus is exactly why they possess this unparalleled talent in MEMS design and signal processing in the first place. It is a talent pool that has proven historically and highly resilient under pressure. We are looking at a company that has successfully optimized its manufacturing cost structure to achieve 23% gross margins in an incredibly difficult environment. We are seeing undeniable elite institutional accumulation by top-tier quantitative funds like Renaissance, who operate purely on data and clearly recognize the statistical mispricing of the Innoviz 3's technical superiority.
A technological superiority that still has to survive the valley of death.
But the convergence of these factors, the deliberate shift toward high-margin physical AI applications in security and off-highway, the radically shrinking hardware form factor, and the severely oversold, heavily shorted market microstructure suggest that this sub-$1 valuation is an extreme market failure. The retail market is backward-looking at past cash burn. The smart money is front-running the 2026 and 2027 production ramps.
And I maintain that hardware manufacturing scales unforgivingly, regardless of how smart the money thinks it is. A 23% gross margin on low-volume, highly customized production does not guarantee structural profitability when you try to scale that volume 3 to 4 times at a contract manufacturer. The institutional churn, specifically the exit of major long-term growth players like Millennium and 2 Sigma, is a glaring red flag that reflects the harsh reality of delayed automotive timelines. Relying on $30 million in new bridge financing while currently burning $80 million in operating expenses leaves the company highly vulnerable to the slightest macroeconomic shock. Narrative re-ratings, like the sudden push toward calling themselves a physical AI company, cannot mask near-term execution risks and the looming mechanical threat of a NASDAQ delisting if they cannot regain compliance.
We can certainly agree on one fundamental truth underlying all of these metrics. Innoviz possesses unparalleled engineering talent in electro-optics. And the current institutional rotation, the shift away from early-stage generalist investors towards specialized quantitative AI funds, is fundamentally altering the stock's microstructure in real time.
Yes. The complexity of transitioning such advanced, delicate technology from the sterile laboratory environment into the harsh, unstructured physical realities of heavy trucking and off-highway mining cannot be overstated. It is one of the hardest engineering challenges of the decade.
Analyzing the upcoming March 23rd Physical AI webinar will undoubtedly provide vital clues to their progress, leaving the careful observer to weigh the data and determine whether this truly is a drastically undervalued AI infrastructure play or a hardware manufacturer struggling against the unforgiving realities of scale.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!